Welcome to Inside Economics. I'm Mark Sandy, the chief economist of Moody's Analytics, and I am joined by my two colleagues and co-hosts, Cris. Cris, good to see you.
Good to see you, Mark.
You're the deputy chief economist. Nothing's changed there.
Good to hear.
Good. Yeah. I was just asking. Not that I heard any rumors or anything. Yeah, but just asking. And Ryan Sweet. Ryan is the director of real-time economics, and good to see you, Ryan.
Good seeing you, Mark.
And I learned something interesting this week about Ryan. You know, he does these forecasts for the economic statistics as they come out every day, and he's really good at it. He spends a lot of energy looking at the DNA of these releases, understanding them, and coming up with forecasts. And you're the number one most accurate when it comes to forecasting CPI. At least that's been the case for a while here. Is that right, Ryan?
That's correct.
Yeah. So he knows what he's doing. In fact, he's in high demand. I probably shouldn't have let anyone know that because some hedge fund might knock on our door or something.
No one's knocking on your door.
Geez.
Wow.
I did not know that. Really? They're knocking.
No, I said they're not. No.
They're not knocking.
You're stuck with me.
I bet. Well, that's because they didn't know. You're a hidden gem. So, but we're going to talk about inflation. So this podcast has two parts to it. Part one is inflation, because a lot of inflation statistics came out this week, CPI, PPI, lots of stuff. And then we're going to part two, we're going to talk about the housing market. A lot of housing statistics coming out this coming week. And of course, housing's on the front lines of the impact of the higher mortgage rates, no more rate sensitive sector of the economy. And we've got a great guest to talk about that, John Burns. John started his own firm a number of years ago. It's grown into a powerhouse now. It's eponymously named. What is it, Cris? What's the name of the firm? John Burns
Real Estate Consulting.
Real Estate Consulting. Very good. And we're going to have John on in just a few minutes. Before we go there, let's talk about the inflation statistics. And I think, correct me if I'm wrong, Ryan, but we should start with the CPI. What do you think? Is that the number?
Yeah, they got all of the attention.
That got all the attention.
Yeah, but there was other good news on, like, producer prices fell, import prices fell, but what really matters for monetary policy is their consumer price index.
Yeah, and so just what did it say? I mean, give us the rundown on the CPI for the month of July.
Yeah, so for the first time in a long time, consumers got a little bit of relief on the inflation front. So consumer prices month over month were unchanged. They had been rising pretty quickly over the last several months. On a year-over-year basis, they're still up 8.5%, but that's weaker than the 9.1% gain that we got in June. So the consumer price data was for the month of July. And a lot of the weakness in inflation last month was energy. So gasoline prices were down more than 7%. And that, really, I think it shaved 0.4 of a percentage point off month-over-month growth in the CPI. So, lower gasoline prices really helped bring it down. I think one thing that, we were going back and forth, like what a surprise was food prices. So, we had anticipated that, the dropping diesel prices would help reduce some of the inflationary pressures coming from food, particularly grocery stores. But that was up more than 1% again. So several months in a row, we've been seeing food prices rise pretty quickly. The good news is that relief is coming. So diesel prices usually, it takes a couple months before they start to feed into the CPI for food. So relief at the pump is here. Relief at the grocery store is coming. But other things that we're paying close attention to, some of the stickier components of inflation. So rents, tenants' rents, owners' equivalent rent, that still remains pretty strong. And year over year, it's accelerating and will continue. And I know John's going to probably talk about this at length, but so there are some areas where we're seeing some acceleration in services, and that's why we need a lot more goods disinflation to offset that services inflation that we're going to see over the next few months. But 1 month isn't a trend, but it's a small step in the right direction that we should see inflation continue to roll over as long as energy prices don't resume rising.
Right. Going back to those food prices, I noticed ice cream prices are up an awful lot.
Yeah, that's going to make my vacation very expensive.
Right. Anybody with children, that's going to be
pretty pricey down at the Jersey Shore with ice cream prices. I think they're over double digits. It's like 10 or 11%. So.
Yeah, it's double digit growth year over year. Yeah, I looked careful. It was a little softer in the month of July, but
Is that a
No
little
pun
play on
intended.
little? Yeah, I was gonna say.
Let me ask you something about food prices, though. I have in my mind that the cost of transportation, diesel, is a big chunk of that. Do you have any kind of rule of thumb as to what percent of the acceleration in food costs over the past year, let's say, has been energy, the higher cost of diesel and transportation?
Yeah, I don't have a rule of thumb, but I did look at it. And if you look at growth in the CPI for food at home, so basically your grocery stores and diesel prices, they're not perfect. They don't track identical, they're not on top of each other, but they generally move in the same direction. But there's a 2 to 3 month lead. So diesel prices come down. It takes a couple of months before it starts to feed into food prices. So that's why we should start to see some relief at the grocery store in the next, maybe not August, probably by September.
Well, it feels like we're going to get some really good additional inflation news here, right? For the month of August going into September. I mean, gasoline, diesel, jet fuel prices continue to fall into August. It's going to bleed through, as you say, or flow through, as you say, into food prices. We get some relief there. Feels like vehicle prices, used vehicle prices are declining now, and it feels like new may start to roll over as we get, the supply chains ironed out, more chips, more vehicle production, more inventory. We got the retailers out there saying, I got too much stuff in inventory. Apparel prices fell, I think, in the past month. We might see more discounting. So it feels like for the next couple, 3 months, I mean, not hesitate to look much beyond that, but it feels like we can say we're going to get some pretty good inflation news here in the next couple, 3 months. Is that?
Yeah, I wouldn't be surprised if the CPI fell in August. I mean, gasoline prices are already down 6-7% so far. And if they follow where wholesale prices, and that leads retail gasoline prices by 2 weeks, they should be down 10% month over month. And that's going to shave a lot off the CPI. Airfares, they're still going to drop. Lodging away from home, because now that we're on the other side of the summer travel season, those prices are really coming in. Rental car prices dropped a ton in July. They're going to continue to drop.
Yeah.
And then new and used vehicle prices, they should start to moderate. So I agree with you. We're going to see some, pretty good. July was a small step in the right direction, but August is going to be very, very helpful.
Cris, anything to add to all that?
It all sounds good for August. I worry about after August, September. Now getting post Labor Day, China opening up, perhaps. We got all the sanctions kicking in, so I'm
hurricane season.
So I'm a little bit more cautious when it comes to energy prices and whether this decline, which is definitely something we need, is going to stick. We may actually see a reversal here if one of these factors kicks in.
Yeah, I want to play statistics game before we bring John on, but there's one other thing I want to tackle on inflation before we move forward on the game, and that is, okay, we're going to see this it feels like a pretty significant moderation in inflation between now and hopefully the next couple, 3 months, unless something goes off the rails like a hurricane knocking out a refinery or something like that. But then inflation may very well settle in, say it's 8.5% July year over year. CPI, it settles in maybe half that, 4 or 5%. And as you point out, all the sticky parts of inflation stay sticky, like the rent and some of the service side inflation. And we're kind of stuck there. And that's where the real risk to the economy is now starting to manifest. Because if it does stick there, that's when the Fed says, oh, I got to press on the brakes even harder, raise interest rates and weigh on the economy to get that inflation, that sticky inflation actually down.
Correct.
Does that sound right? Is that how you're thinking about this as well, Ryan?
Yeah, I would agree. And I mean, yeah, the sticky components of the CPI worry me, but they won't be sticky for long because eventually the Fed's going to kill it. They'll push the economy into a recession if they think, inflation's, sticking around 4.5%. I mean, even after the CPI, the Fed officials, like all the Fed speak is still saying, we're going to avoid what we did in the 1970s. We're going to keep raising interest rates until inflation gets back down to 2%.
Yeah. Cris, anything on that question about sticky inflation down the road here?
Yeah, I think Ryan characterized it correctly, but that sticky component is really hard to unstick with the unstick on the supply side, right?
Yeah.
We can get perhaps we can get the oil result, we can get the food result, but then the rents, right? we're not going to get a whole lot more supply anytime soon. So that's not going to really.
Yeah. Well, I
feed
guess in the baseline scenario where where we don't have a recession, the Fed doesn't need to step on the brakes. We have the Fed raising rates a few more times here. The terminal funds rate, the high point in this cycle is 3.5%. We're at 2.5% now. Assumes that inflation does continue more or less to moderate, that it doesn't stick at 4 or 5%. It continues to moderate. And that's based on the expectation that the economy's growth is going to slow, that job growth is going to slow,
right,
almost to a standstill. We may even see some increase in unemployment from the very low 3.5%. That takes the steam out of wage growth, which is the key source of inflation on the service side of the economy. And that's enough to keep inflation moving lower. And then as you move towards the end of next year, going into 2024, at that point, you'll see rent growth starting and shelter cost inflation starting to moderate, because you're already seeing market rent growth kind of roll over. It's still extraordinary double digit, but it's just not quite as extraordinary as it was earlier in the year.
Correct.
So that's kind of the baseline. Does that still fit in your thinking, or would you take umbrage with that?
And that's what the bond market's saying too. So if you look at 5-year forwards, like measures of inflation expectations, inflation swaps, they all, indicate that the Fed is going to get inflation back down to target over the next couple of years. So the bond market isn't saying that inflation is going to be stuck at 4.
Of course, they seem to be saying we're going to get there with a recession, right? Because the yield curve is deeply inverted now, 2-year, 10-year. So it doesn't feel like they're kind of on the same page we are.
Yeah.
Yeah. Okay.
Well, we get to the same destination, but
it's just different ways.
Well,
different
that's a big difference, guys.
Yeah.
From my perspective,
For sure.
big difference. But I don't want to talk about the yield curve now because we don't have enough time. We're going to talk about that maybe next week. A lot to talk about there. And we're going to come back to that in part 2. I think I brought that up in part 2. We'll bring that up in part 2. On the housing market. But let's play the game, the statistics game. We each put forward a statistic. The rest of us try to figure out what that is through clues and questions and deductive reasoning. We want a statistic that's not too hard, not too easy, kind of related to the topic at hand. So, okay, let's go, Cris. You go first. I always go to Ryan first on this thing, but let's go this week to you first.
All right, 62.8.
Is this from the CPI report?
Nope.
Ooh.
Is it inflation related?
No.
Is it a statistic that came out this week?
Yes.
This is from the NFIB.
No.
National Federation of Independent Business Small Business Survey. Is it from the University of Michigan survey?
It is not.
We're running out of things here.
Wow.
It is housing related. How about that? It's
housing related.
Sticking to the theme.
Oh, right? Is this something around from the housing vacancy survey?
No.
Because that came out the week before.
It came out this week, you said?
Yes.
Oh, okay. Well, sorry, Ryan. And maybe I got my weeks messed up.
There we go. It wouldn't be the first time.
You're such a data snob. You know that? You laud it over the rest of us. I know the data so well.
Oh, here we go. This is definitely. Is this one of your surveys that no one?
Yes.
Okay, so this is
survey.
Like a Fannie Mae survey.
Yep. Of course, the Fannie Mae home price sentiment survey.
Oh, that's
home purchase sentiment.
Who pays attention to that survey except Cris?
Yeah.
Okay, what's 62.8?
That is the index value for July. It is the lowest since 2011. Right. So it got down to 63 in April of 2020 during the pandemic. Right. So this is people's feelings of whether the housing market is a good time to buy, a good time to sell, whatnot. So ask a bunch of different questions about housing. So sentiment around housing is quite low. One thing I found particularly interesting is that both questions around whether this is a good time to buy and whether this is a good time to sell fell a lot over the last year. So there's pessimism on both sides of the equation right now.
Yeah, that sums it up. And really good statistic to lead us into part 2 on housing. So, but
I thought so.
No, that's a good one. That is a good one. And I'm going to put that way in my memory banks because I know it's going to come up 5 times in the next 5 years. This survey. All right, Ryan, what's your statistic?
All right, I got a trifecta. So 0.3, 0.4, 0.5.
0.3 is core CPI?
Correct. Very good.
0.4, is that median CPI?
Oh my God. This is unbelievable. Yes, that's correct.
It is 0.5 trimmed.
Oh, how did you
CPI.
do this?
Oh,
This is
baby.
yeah, all right, that's a cowbell. All right, now I'm really impressed.
And because I got yours, that is definitely not collusion. There is no collusion.
No, there's no collusion there. That's
I don't
really
know.
that was really
I
impressive.
don't know.
Flawless the way I said that.
No, so when I was looking at this, I'm like, oh, Mark's gonna give me grief because it's median and trims. And wow, that was impressive.
Suspicious. Very suspicious.
What are you talking about?
There's no way.
Explain
guys,
yourself,
I don't
Ryan.
know.
What are these numbers now?
The
Now that
different
everyone
ways.
knows that I know that you know that I know whatever.
Mhm. There's just different ways of measuring inflation. Hold on.
Is that all you're going to tell us? Different
No,
ways
no,
of measuring inflation? Are you
the
that
Bloomberg-
depressed?
No,
You're
the
not gonna
Bloomberg
tell
terminal was
us?
talking to me, so I got distracted.
Oh, you got
yeah,
distracted. Oh,
Yeah, it's different ways. So the core inflation that excludes food and energy, and then the Atlanta Fed puts out different ways of measuring inflation as well, looking at the median, so like the middle of all the price changes, and then the trimmed. I like the trimmed one because it kind of takes the extremes out. So big price movements, big increases and big decreases, cut those out and take out some of the noise and just look at the signal. But overall, the general takeaway is that looking at median and trim, that these price pressures, they're starting to broaden out, and that's what you can really see in the CPI data.
got it. How do you feel about 0.3, 0.4, and 0.5 in the grand scheme of things?
It's a lot better than it was a few months ago.
Yeah, exactly. 0.3 core, I'll take that it feels like I'll take that
yeah.
all day long. Give me that one. Hey, I read something you wrote, which is important, that if you, based on the CPI and the PPI reports, the producer price report, that we can now have a pretty good forecast for the core personal consumption deflator, which is the measure that the Fed uses. What is that saying? What do you think? What's your forecast for that?
It's going to be up 0.1%, which puts year-over-year growth at 4.7%.
That's core. That's
core.
Excluding food. Okay, so 0.1. That's pretty good. We take all day long.
Yeah.
Right. Yeah. Because that means we're back. Well, that would be back to the old days when inflation is too low, right? So,
exactly.
Yeah, but that of course is not happening here. Okay, you ready for mine?
Yep.
I actually think this is a good one, and I'm not sure you're going to get it, but it's a really good one. Ready? 3.64%. And I'll give you a hint. It has nothing to do with inflation. 3.64%.
Is it an interest rate?
It is not. That you would think it might be, but it is not.
It's a housing related.
It's mortgage related.
Oh.
Yeah, that's a big hint, by the way.
Delinquents?
Yeah, the mortgage delinquency rate. Yeah,
Right.
yeah, that came from the mortgage bankruptcy system.
Yeah.
Chris, did you know this? This is Q2 data.
Yeah.
It hit an all-time low.
Yeah.
In the data, 3.64%, which is just incredible, right? I mean, and you saw a big. Now, I thought maybe what was going on is because of the end of these very forbearance programs. You might see, because as you know, during the pandemic, people could go, if you had a Fannie Mae, Freddie Mac, or FHA loan, you could get forbearance from paying your loan. And that program is expired. And so you got people that are rolling off the forbearance program. And I thought maybe they'd be going in, and you did in fact see a big decline in 90-day plus delinquency. And you have seen a bit of a pickup in foreclosure.
Yeah.
And that's part of the story. But even if you add the delinquency rate plus the foreclosure rate, it's an all-time record low. It's an all-time record low, which is amazing. Now, it still probably overstates the case because there's about 500,000 people that are still in the forbearance programs. Let me ask you this interesting question. How many households do you think got forbearance during the pandemic on their mortgage at one point or another during the pandemic? And I know this because the Philly Fed puts this great report together on the forbearance programs every month. Take a guess.
Yeah, I was watching it closely for a while, but
not
anymore. So,
just to give you a hint, there's about 50 million people out there with mortgages. How many of them do you think actually were on the forbearance at some point?
At some point?
Yeah, 9 million.
I was going to say 10%.
Yeah, I mean that's pretty significant, right?
Yeah,
9 million, and we're down to 500,000 as of the month of I think July or early August. And they're coming off quickly. So we might see some increase in delinquency. But my point is, well, first of all, the mortgage borrowers since the financial crisis are really good borrowers, very high credit scores and, getting 30-year, 15-year fixed rate loans, kind of plain vanilla, nothing exotic, no neg am, no 2-year subprime. And of course, with the house price growth that we've seen, they've got a ton of equity built up. And because unemployment is 3.5%, people still have their jobs and they're making their payment on their mortgage. So that's that's through the second quarter of this year. That gives you, in my view, a sense that the American family household, certainly the homeowners, in pretty good shape.
Homeowners, yeah,
homeowners. But that's 2/3 of the population, right? Yeah.
Yep.
So and that's where the bulk of the spending is. I mean, most of the spending.
Yes.
Yeah. So I thought that was pretty interesting. Anyway, no one got a cowbell on that. No. Yes,
No.
yeah. But I have to say, I was very impressed with my response to Ryan's question.
Surprise.
Yep.
All right. Well, now here, we talked about inflation. That was the past week. Now we're going to think about the coming week in housing. And no better person to have on to talk about housing, as I said earlier, is John Burns. John, welcome.
I'm ready to roll whenever
You're ready to rock and roll. Well, it's good to have you on. You're not on video because your Wi-Fi isn't all that great. Where are you? Are you kind of backwoods of Alberta or something? Where are you?
Oh God! If you saw my view, it would kill you. I'm at a resort called Terranea in LA. I'm looking at the Pacific Ocean.
Oh,
but
man.
the Wi-Fi here is horrible, which is a way of them saying you should not be working when you are here.
You should be looking at the ocean.
Yeah.
It sounds like it's intentional. Yeah. Well, it's so good to have you, John. I don't think you've been on the podcast, have you? Is this the first time I think it's the first time you've been on. It's good to have you on. And just as a way of introduction, you have a highly successful consulting firm that you founded, eponymously named John Burns Real Estate Consulting. And you're actually headquartered in Southern California, right?
Yeah, I named that when it was just me, so things have changed a little bit. We need to rename that. Okay.
Yeah, and but you now have, as I recall, you have in previous conversations we've discussed that you have offices and folks all over the country because you closely monitor what's going on in all these new housing developments across the country. Is that right?
Yeah, we've got more than 100 people spread out across the country, and we're so good at this work from home thing. 2 of our employees, but one moved to New Zealand and one moved to England more than a year ago, and they're still with us.
Wow.
You could say we're international, but that's really misleading.
Yeah. Well, you were kind of leading edge on the whole remote work thing, weren't you? I mean, because you had folks all over.
Big time. Yeah. I mean, if I had to recruit only people that live near me, we would not have nearly the talent that we currently do. So we leaned hard into that, and we've been on Zoom for years. And when everyone else got on Zoom, we couldn't have been happier.
Oh, that's interesting. You were on Zoom long before the pandemic.
Oh, yeah.
Oh, really? I didn't even know it existed before the pandemic. Oh, that's interesting.
Yep.
Oh, wow. So your productivity has been enhanced by everyone getting on Zoom.
You have no idea.
No idea.
We can have so many client meetings per day now. I mean, it's phenomenal. And people say, you don't really have those connections. We actually have a whole training deck. I actually gave a presentation on it to a bunch of CEOs on how to be connected remotely. And nobody believes me except my staff we've hired, who said, I feel more connected to this company than I did the people I saw in the office every day when I used to go into the office every day. So it can be done.
I feel the same way. I totally feel the same way. I feel more connected than I ever have because of Zoom. I mean, because it facilitates so many meetings and points of contact with people that you just wouldn't have had before. I just find it amazing. But glad to hear that's working for you.
I know so much more about your home decor, Mark. I feel real connection.
Oh, that's a good point, right? Yeah.
I'm looking at your background
John,
there.
You can't see because even though you're a Zoom maven, you're not on Zoom, but I'm in my not elsewhere classified room. So anything that I don't know where to put, it comes in this room. So,
Mark, last time we Zoomed, you were on your patio, and I got a good look at your yard and the whole thing. It was awesome.
Oh no, I wish I was out there right now, John. I tell you. But let's get down to business and talk about the housing market. So how bad is it, John? It just feels bad. But tell me, how bad is it? How would you characterize the housing market at this point?
It's declining pretty darn rapidly. This is going to sound a little horrible, but it's not that bad. Because if your home price went up 36% in 2 years, and then you had to give 5% of it back, not that bad.
I'll take that.
Yeah, I take that.
But all my home builder clients, all of them have the strongest balance sheets they've ever had, and they're kind of saying, "Well, I knew this wouldn't last, and I've been preparing for it not to last. It actually lasted longer than I thought it was going to." And so if I have to give some back right now to keep moving forward, that's fine. In fact, I'll tell you, most of them are continuing to hire people right now rather than let people go.
Oh, now that's
but we'll see. I mean, we'll talk about this later. If you start talking about a serious recession or double-digit mortgage rates or something, that's another story. But right now, that's where their head's at.
Right. I mean, and I guess most of your work is focused on the home builders and the whole complex of home building. Do you also focus on the demand side in terms of home sales and realtor activity, that kind of thing? So when you say it's not that bad,
well, yeah, you have to, for the mortgage. I know, right? So
yeah.
This is tough for people in the mortgage industry.
Yeah.
People, resale. There's more resale agents than ever before too, so it's very competitive for them. I don't want to, Pollyanna it for everybody. And we also have a very large. It's become almost half our business now, the rental side, and rents are going gangbusters. So from a business standpoint, they're doing great. I know tenants don't like it, but
right. This single family rental. The single family rental is what you're talking about.
Yeah, and apartments too.
Oh, and apartments. So yeah, sure, absolutely. Rents are rising very rapidly. Right. Okay. So you're saying interesting. You're saying it's you can't paint with a broad brush here. It's not all darkness. That there is shades of gray and even some blue sky here for some parts of the housing complex.
Yeah. I mean, the dark stuff is what you read in the press, and I don't want to Pollyanna. I mean, some of my clients' stocks are down 90% plus, right? So. We had tremendous price appreciation. In 2019, the market was getting a little frothy. And then we had the spring of 2020, which was horrible. And then we had 7 quarters in a row of 4 to 5% price appreciation. And it seems to me just about everybody was thinking this is going to end at some point. This is going to end at some point, and it has. So,
right.
But they were prepared. I think most business people were prepared for that. And I even think the mortgage guys, I mean, they all knew that that's how this business works. It booms and it busts.
Yeah. So they're buckled in and prepared.
I think
sounds
so.
like what you're saying. Yeah. They're yeah. Hey, Cris is a great housing mortgage guy as well. He came to us from Fannie Mae many years ago now, but obviously pays very close attention to housing and housing finance. Cris, how would you characterize the housing market at this point? I'm just curious how your thinking lines up with John's.
Yeah, I would agree with him, right? I think things have gone on longer than expected, and folks in the business have been anticipating that they couldn't go on forever. We've been through this before, right? So, you want to be a little cautious or have some safety in the background. So I think that's why you didn't see mortgage lenders going crazy with lending standards and, really stretching. They didn't need to. And I think there's been that discipline on that end. And I think even on the construction side, the builders also didn't go as crazy as they potentially could have in the face of all the demand, and took a more disciplined approach, having been burned in the past. And I also think that perspective is important, right? Things are down now, but relative to where they were in 2019, we're still looking pretty good. So it's not like as those sales have collapsed just yet, right? So it's not it's not a calamity or catastrophe
Yeah.
that we're looking at here. It's more of an adjustment, anticipated a period of transition or adjustment. We knew this was coming, right?
A correction, not a crash. Yeah. Right. Okay. But a lot depends on a couple of variables, right? One is mortgage rates. The other is the economy, jobs. And John, when you think about, where housing is headed, do you have like a perspective on, where mortgage rates should be, where they're going to, right now, the 30-year fixed mortgage rate it's down a little bit from where it was just a few weeks ago. I think we're at 5.25% last time I looked. I think we were as high as almost 6% a couple months ago. And of course, if you go back a little over a year ago, before we really got going here and the pandemic started to fade, I think the 30-year fix was about 2.6, 2.7. I think that was the historical low. Do you have in your mind a sense of where mortgage rates will settle and where they're headed? So when you had this kind of sanguine, relatively sanguine perspective, feels like, are you also relatively sanguine about mortgage rates, or how do you think about that?
Well, mortgage rates, as you know, basically traded a premium over the 10-year Treasury, and you can go into your Bloomberg terminal and see what the futures are in the 10-year Treasury. So I'm not going to be smarter than the bond market. So I just look at what the bond market is saying. And
by the way, Ryan tries every day to be smarter than the bond market. So
right. Well, so he's right half the time and wrong the other half.
Exactly.
But look at it.
Yeah.
Yeah. So and that's what I tell my clients, and they're not smarter either. So let's look at where the 10-year Treasury is and where it's projected to go. That's the most likely scenario. Mortgage rates traded 100, and that's because a pool of mortgages usually pays off after 10 years because somebody refinances after 6 months and somebody holds it for 30. The premium over that is usually 170 basis points. So we do forecast what we think the premium is going to be, because that will move up or down. It's up right now because it goes up when people are afraid of a recession, and I think there may be less liquidity in the mortgage market during a recession too. So people will ask for a premium on that. But this is the first cycle any of us have been through where the Fed actually buys and sells mortgage securities by the trillions. So Powell is manipulating the mortgage market, in my view. So you have to put that into your calculation. And we're forecasting the rates should be relatively flat because that's what the 10-year Treasury is saying, and maybe even come down a little bit once we get through a recession, if we are having one. So that's the scenario we're running with, and that's what our clients are running with too.
Got it. So you think a prudent planner here home buyer, home seller, home builder, realtor would be a 30-year fix that's kind of sort of where it is now, somewhere between 5 and 5.5%. That's kind of what you think the prudent planner would count on.
That's what the bond market is signaling.
Yeah, right. Okay. Ryan, it's very similar to our perspective, right?
Yeah, very similar.
Yeah.
We have mortgage rates moving sideways, and that's going to put a little bit of a floor on the housing market going forward. And the other thing to keep in mind is that once we get through some of these ups and downs in the economy, there's 40 million millennials that are moving into their prime first-time home buying age. So that's going to be an enormous tailwind for housing going forward.
See, I have this feeling I got to be the downer here. You guys are like all positive.
That's going to be really hard for you to do.
I know.
You're like uber pessimist.
Usually I'm on the other side of this thing,
yeah.
But now you're forcing me to take the other side. Interesting.
Well, I'll be a downer on that millennial statement. I think that,
okay, go for it.
It's pretty much in the rearview mirror. I mean, the bulk of births was in the early 90s. Those people are turning 30 right now, and so there's like a 89 to 94 window there. But the births are tailing off after that.
Yeah.
So basically, one way I explain it to my clients, they kind of get it. Like, that apartment boom we had 10 years ago? Well, that's a for sale boom now. But that only lasts for a little bit. And actually, when you run the math, I think that 40 million number is right, but it's not that much more than the decade before. And so it's not some huge, like, I'm going to hang a very positive hat on the housing market because of this millennial thing. I think it's a slight boom that basically we're almost of the way through.
Interesting. And Ryan, you should know John wrote a really good book. It's probably now 3-4 years ago, right, John? Or maybe 2-3 on
6 years ago now.
Oh, goodness. Okay. I didn't realize. On demographics and its role broadly, but in terms of the housing market in particular.
Can I be a bear on this again? We said we needed about 1.37 million housing units built per year over the next decade. We said that in 2016, and people were like, "That's ridiculous. We need way more than that." We did 1.35 for the first 5 years of that. People just need to run the math, and that's what. Yeah. And when you run the math, now we were oversupplied at the time. Now we're undersupplied, so now we're more in the 1.55 total camp we need, including manufactured homes, by the way. And we're pulling more permits than that right now. So we still have this pent-up undersupply issue from the last few years. But there's some negative people out there who are right. They're saying, well, this 1.7, 1.8 is not sustainable. And probably the most important thing that people don't think about there is the building products companies are only going to add new plants and new capacity if they think, hey, 2 million a year is the new norm. They're not doing it because they can see the demographics in this country and they say, we've already got enough capacity. Now we're having a supply chain issue right now. But that's been a pain point for the home builders during all this, because the supply is that. But the people that build the materials don't believe some of the bullish statements, and I agree with them.
Okay,
Cris, look at Mark's face.
Yeah, this is very
he's crunching these numbers. He's realizing his housing starts forecast is completely off.
No.
Oh, we made a big change this month.
Yeah.
Oh, wait. This is very interesting because John, you're right in the middle of an ongoing debate we're having in our own forecast. I wanted to go here a little later in the conversation, but maybe we're here. We should do it. We'll come back to, the near-term outlook for housing, because I did also want to talk to you a little bit about where you think the economy's headed, because that's in jobs, because that's also, in addition to mortgage rates, that's critical to determining, where things are going in the near term. But let's stick with this the conversation around supply. So just so I understand, abstracting from the business cycle, over the next, let's say 5 years, maybe over the next 10, you pick the horizon, how many single family, multifamily, and manufactured homes do we need to put up, do you think, given the demographics?
15.5 million over the next 10 years.
50, so that would be 1.5 million per annum.
And it'll
1.6.
some years will be a lot more, some will be a lot less because of the economic cycle, but that's what we need demographically.
Okay, so Cris, are we that different? We're not that different from that, are we? We're pretty close to that.
Now we're not.
No, we're not. Okay.
No. Now.
Oh,
month,
now we are.
As of our change.
Yeah.
We're not. We're quite close to that.
Right. Well,
prior to this month, we were on the high end, but
okay.
Made a change.
Okay, so but we at some point here in the not too distant future, in the next 5 years, it feels like it's got to be, again, abstracting from the business cycle, we've got to have much more construction than that, don't we, John? Because, and this is how my thinking around this works. The vacancy rate across the housing stock for rent, for home, for ownership is pretty close to a record low, about as low as it's ever been. And we got data all the way back into the 50s, I think.
60s.
60s, right. I think the home ownership vacancy rate actually is at a record low. The rental vacancy rate is not quite. And that is manifested in high house price growth, strong house price growth, and very, as you pointed out earlier, strong rent growth. That's not sustainable. So we need to see rent growth, house price growth come in to something that's more consistent with incomes and construction costs. So that requires a higher vacancy rate. So at some point in the not too distant future, we need construction that's going to be above 1.5, 1.6 million to get that vacancy rate back up to something, what I would call, an economist would call the natural vacancy rate. Is that kind of how you think about it, or you're landing in a similar place, or how do you think about that?
That is how I'm thinking about it. But the low vacancy, the undersupply you're talking about, our estimate of that is 1.7 million units. That's in my 15.5. So if we didn't have that, we would be, forecasting 13 and some change, which is what we were doing in 2016, because we believed at that time we were oversupplied because the vacancy was the exact opposite of what you were just talking about in 2016. It was actually quite high.
Right. Okay. Well,
Yeah, we've run the math.
You think the undersupply is 1.7 million? Is that what you just said?
Yeah, we think if you look at the demographic demand for shelter, we should have 1.7 million more housing units built right now.
Okay, we're like twins. I mean, aren't we, Cris? Intellectual twins here. I mean, that's exactly what we're saying. Well, not exactly. We're saying 1.6 million.
We're in that a lot depends on what your assumptions are for household formations and headship rates, but we're in that ballpark certainly, right? There are other estimates out there of 3, 5 million, 7 million shortage, and that just seems way overstated.
Okay, but so
can I bash those?
Feel free.
So they're all very simplistic analysis. Nobody ever says exactly what Mark just said about the vacancy rate, and people point to 2000s we built this. Well, 2000s we overbuilt the market.
Right.
And so they're very simplistic analysis. That's very easy to fall in the trap of thinking we're underbuilt by 5 or 6 million. And most people I think have heard the argument from me and Mark and others now, and are dropping their numbers back down closer to us.
Oh, is that right? I didn't notice that. Is that people are coming in?
Yeah, I've seen a lot of people. I won't name names, but there was one who was one of the first ones out there who was saying we're undersupplied by 5 million, and they're now down around 2.
Yeah. Okay. Interesting. So, but that does mean or imply that at some point, not this year, not next year, because of the higher mortgage rates and the adjustment and the weaker economy and so forth and so on. But at some point in the not too distant future, kind of mid-decade, it feels like we should be seeing years of 1.7, 1.8 million kind of housing starts, John?
Yes, I think we're going to see that this year. Yeah.
Oh, so this year. Right. Oh, okay. Really?
Well, what are we running at right now when you throw in?
Well, we're at 1.6, actually 1.55 last month. We were at 1.8 in April, and we've come way down because builders seem to be freezing up here, a bit, if you believe the data, the census data.
Yeah, no, the last months have come down, but I think we were on pace to do above 1.55 this year. And there's so much already under construction that's going to get finished. I don't know our exact numbers, but I think we're going to exceed that. And then after that, it's going to come down because, and this is where I think we really have a competitive advantage, is our home builder clients are telling us, here's how much we're going to build. Here's our business. It's all about, they build it only if it's the right financial decision for them. And it's going to be an interesting conundrum next year because they've already bought the land to have more open communities. So they have more actively selling communities next year than they do right now. But the sales pace per community, which has been running close to 3, is probably going to get down around 2. So it'll probably be less construction next year at the end of the day.
Right. Okay. Interesting. So and the numbers we've been banding about have been really housing starts, not housing completions. And it feels like we could get a lot more completions than starts, right? Because it got this boatload of homes that are in the pipeline going towards completion, kind of mucked up because of the supply chain issues. And you're saying those completions are going to get across the finish line here over the next maybe year or so. And so we get more.
Oh, yeah.
Right. Yeah. Oh, okay. Interesting. So Cris, it feels like our forecasts are now, we have marked down. You're right. We have marked down our forecast a bit, but it feels like our forecasts now are very consistent with John's. Would you say? It feels like it.
Yeah, it's certainly much more consistent now.
Okay.
Yeah.
All right.
Where things really get interesting, I don't know if you want to go here, but if you look out beyond 2030, right?
Well, let's do
demographics.
Yeah, go ahead. Yeah. So what do the numbers look like? You've actually noodled it out 10 years, 15 years from now, and it looks, what do the numbers look like way out there?
Yeah, there's a continuous decline because our household formations keep shrinking, right? We're we're getting past this bubble in terms of the millennials, as John mentioned. The subsequent generations are smaller. And at the same time, you're going to have the baby boomers who are hanging on to their properties today, even with second homes, third homes, moving on. So that's going to free up some more supply. So based on our projections, right, that construction industry is continuing to decline over time in terms of total output per year. The only wild card there might be climate change or losses of properties if we're hit by more storms or something along those lines.
Or immigration policy.
Or immigrate. Well,
yeah,
we're assuming.
You're totally right. I mean, you just hit the one thing everybody misses is the oldest baby boomers, 76 right now?
Mm-hmm.
That birth surge we saw in the late 40s and early 50s is going to start providing some resale supply to the market for the first time ever.
Right.
So we've been having these demographics where we had like 4 million people graduating from college or high school every year, and 2 million people passing away, to going to like 4.3 million people graduating from high school or college and 4 million people passing away.
Right.
That's not a lot of growth.
That's, yeah. Cris, remind me, like if you look 10, 15 years out, what are we saying the underlying pace of housing construction should be, starts? Are we down to 1 million or less per annum?
I think it's less.
It's less.
By that point, yeah.
Right. Okay. Yeah. John, you're coming to the same place, right? When you look out, given the demographics that you so carefully look at, it feels like, unless immigration changes to a dramatic degree, we're going to be looking at much lower levels of housing construction out there 10, 15 years from now.
Yeah, I think you're right. I have not done the math past 2030. Below 1 million sounds really low, but maybe you're right. I need to go run that math.
Yeah. Okay. We can share that with you. We got a very elaborate spreadsheet now, which is actually pretty cool. It's been very informative. I know Cris is writing a paper on this right now. Okay, very good. Oh, one other thing on the affordable housing, the shortage, the 1.7 million. Do you think there's any role here for policy? Should policymakers be doing anything? If you were king for a day or a week, would you change anything with regard to housing policy to incent more construction, or not? You just leave it up to the market to figure this out.
Well, we're definitely not a policy shop, and I'm not a policy guy. But I'll tell you what seems to be working is some of the job creation outside metro areas. I mean, I don't know what federal policy can do to stop NIMBYism.
Yeah,
maybe you can figure that one out.
Right.
But if you look, like just in the last few months, like Mazda and Toyota are going outside of Huntsville, and Kia and Hyundai are going down to Southeast Georgia, and Volkswagen's going to Chattanooga, to areas where there's not a lot going on, and they're going to create jobs and they're going to create housing. And the government, and maybe it sounded like there was some stimulus for EV cars and other things in this latest policy. Yeah. That would support these companies doing this. This is going to provide areas where there's no resistance to development to allow economic growth and affordable housing.
Mm-hmm. Mm-hmm. Right.
In Asia, they build new cities. They go to the middle of nowhere and they, put up a city with 500,000 homes. It feels a little bit similar here.
Right. Oh, that's interesting. So you're saying the market forces may actually iron this out reasonably gracefully, just because of the move towards suburb, sort of exurban rural areas. It's ongoing. And I guess remote work might, and maybe that's what you're saying, facilitate that as well, that people can move to.
Could.
Yeah.
Those areas need infrastructure and other things. I mean, if policies that would provide those sorts of things would certainly help.
Right. Right. Yeah, absolutely. Okay. All right. Let's, Cris, Ryan, anything else on this that we should bring up with John in terms of the affordable housing shortage and housing activity? Anything else you want to bring up here? Do we cover it, Cris?
Yeah. No,
we got it. Okay.
We got it.
Okay. All right.
Agreement with John. So
okay, let's double back. Now, because we went from the short term to the long term, I want to go complete the conversation around the short term. We talked about mortgage rates, and we kind of said settled on 5 to 5.5% for 30-year fixed. John, how do you, when you talk to your clients, they must be asking you about the economy, about jobs, right? Because that's the other big component here in terms of housing demand and housing activity. What do you say? How are you thinking about that in your look forward on prospects for the housing market?
First of all, I'll say we devour all the Moody's information on that. So
okay, very good. I like that.
I actually think you are the best ones out there at doing that. So thank you for that.
Oh, you're really believe that, John? You're not sucking up, are you? That you can.
Well, you want me to dish you a little bit?
Dwell on that
statement.
Competition's
not very good. I mean, you've always looked at it by sector, and then rolled it down to the metro area. At least that's what we see.
Yeah.
And I think that's the right way to look at it. And the tech sector, with all those companies that grew 400% in 5 years, they're getting hammered right now. And the mortgage industry is getting hammered right now. But I'm starting to come to the conclusion, and anybody who's made a lot of growth bets, any company, and hired a lot of people and taken on a lot of debt, that's what I'm concerned about, because of last recession aside, 11 of the prior 12 recessions were all fueled by excessive debt somewhere in them. Yeah. And so that's where I try to focus on, okay, who's over levered? And I see a ton of companies now whose debt is up, but they've hit the bond market and it's not due for 5 years. And by the way, it's at 4.5%. It might be trading at 9 right now, but their coupon's only 4.5, so they're fine. But then what concerns me is what I don't know. And the CEOs of the 3 biggest investment banks, JP Morgan, Goldman Sachs, and Morgan Stanley, have all come out with huge bearish comments about there's a hurricane on the way, and even overriding their economists, there's greater than a 50% chance of a recession. Those guys are seeing something that I'm not seeing, and that's what scares me. So we're telling everyone, be really cautious here, because of what David Solomon at Goldman Sachs is saying, and Jamie Dimon and James Gorman. They're smart people.
Yeah, no, absolutely. It is interesting though, and I follow the economic shops of all those Wall Street firms. None of them have a recession in their forecast. None of them. I don't think. I'm sure JP Morgan doesn't. Goldman doesn't.
Well, ask them if they're looking at their own loan book, which they're probably not even allowed to.
Oh, the economists, you mean?
Yeah.
Oh,
yeah.
Okay.
What are the levered loans that they've been selling to insurance companies?
Yeah. Interesting. So this has been bugging me, John, that we're going to talk ourselves into a recession. That, when folks like, Jamie Dimon, I'm not sure if people pay attention to Elon Musk and what he says, but he's saying roughly the same thing. The hurricane is coming. It just makes people nervous, and it becomes self-fulfilling almost.
Why would he say that when he's trying to convince you to buy his shares?
Well, I don't want to speculate. I've got I've got thoughts on that, but I don't think I should speculate. Not in the podcast.
Okay.
Yeah.
But, all right.
Yeah. But it's a good question. It's a good question. But so it makes you nervous. So you're saying recession, recession risks are high because these people who clearly have information on what's going on deep in the financial system and economy are speaking very darkly, and therefore have to be cautious about what's going on here.
I worry about what I don't know.
Yeah.
I in the last cycle, I got lucky and had John Paulson and Steve Eisman as clients, and they were telling me what's going on in the mortgage securitization world. I had no idea. Thank God they clued me in.
Oh well,
I keep asking people if there's something like that out there, and I haven't heard of anything.
Yeah.
We're not forecasting a huge negative recession. I'm just telling you risk on because of some of what these other guys are saying.
Got it.
One other thing I'll tell you, I did see in my business, we had years of really low interest rates. And so the thirst for yield by bond funds was insane. I mean, how do you get some 7 or 8% interest? I mean, pension funds need what, 7 or 8% per year? How do you do that? You have to take a lot of risk. You have to buy the, first loss piece in some tranche of high yield debt that probably wasn't even rated by Moody's.
Right.
That's what keeps me up at night, is that stuff.
Right. The unknown unknowns, I guess that you would call them. Interesting. Hey, Ryan, you're listening to that. What is your sense of that? I mean, what do you think when you hear John say that about these dark comments coming from senior leaders in the financial system?
No, I agree with him. I think that's the one thing that makes me nervous as well, is that there's the economic data saying that we're not headed toward barreling towards a recession, but when you have these bank CEOs coming out, and to his point about the corporate bond market, I mean, it's the junk of the junk that really could cause some problems down the road.
Right. Okay.
And again,
but you follow the corporate debt market closely, but you're not seeing anything, right? You follow it very closely. You're following it for issuance and by rating
spreads. Yep. Everything.
You're not seeing it.
In aggregate, everything looks fine, but you don't know if there's something bubbling beneath the surface that we may not have data on, and that maybe this is what the bank CEOs are getting worried about, because his point's spot on.
I'm not worried about good companies.
Right.
Yeah. I mean, good companies have good debt. And actually, I mean, good companies with solid balance sheets, their debt is trading at a 10% yield right now. Those are pretty good yields.
Yeah. There's nothing to worry about in the investment.
I'm more worried about the other stuff. I have a client who is lending against people's crypto balances. Okay. As a small percentage of their portfolio to get some yield.
Right.
That's the stuff out there that I worry about.
Yeah, that would make me worried.
What's that?
That makes me worried.
Right.
Yeah.
That makes you worried.
Well, how many companies are lending to hedge funds
Mm-hmm.
whose portfolios whose assets are down 30%? Where's that debt? That doesn't trade anywhere you and I can look at it.
Mm-hmm.
Right.
I don't want to be super bearish here, but I'm focused on what keeps me up at night.
Yeah.
I'm not saying this is what's going to happen.
Yeah. Okay. That makes sense. So you're saying, okay, Mark, I buy into your baseline, no recession. It's going to be uncomfortable, kind of an economy, tricky, slow growth, on the border of recession, but no recession. But having said that, the risks are definitively on the downside. And I'm really, if something is keeping me up at night, it's all these things that could be going off the rails in the financial system that are very opaque. We don't know. And that makes me worried. That's what you're saying. Yeah, that makes sense. Yeah, right. Okay. Fair enough. I'm not going to try to cheer you up. I think that's very reasonable. Let me ask you, let's go back to the housing market. And one other thing that we talked a little bit about, but I just want to talk about it a little bit more, is about rent growth. And as you pointed out, rent growth has been extraordinarily strong, double digit year over year, now for more than a year, pretty much everywhere, coast to coast. Strongest in the South and the West, as you would expect, given all the remote work and people moving in. But it's everywhere. Here in Philly, if you go look at the data, we never see double-digit rent growth in Philly, and we're seeing double-digit rent growth in Philly. So it's everywhere. Mm-hmm. So how does that get resolved? Is it that builders do continue? This is one reason why they're not going to really pull back on their building during this weak period, and that we are going to see a lot more construction going forward. We're going to get that supply and get that rent growth down. How's that going to play out?
Well, it's the same thirst for yield that also is an inflation hedge has caused a ton of capital to come into apartment construction and single family rental home construction for rent. Because there's a huge desire for that. If we have a lot of inflation, then the tenant's income is going to go up, so I can raise rents. If the cost of the building is going to go up, there's some inflation hedge there too. Rising mortgage rates creates more rental demand because it takes it away from home ownership. Mm-hmm. And the inflation statistics here, where we have a guy, Eric Finnegan, who monitors all the inflation stuff for us. The rental component of that is super lagging. So you know that the next year, the rental component of inflation is going to be higher than it is right now because those rent increases have already occurred. It's fascinating, and I'll just say with some humility here, we got that totally wrong. I mean, we did not see double-digit rent growth coming in any way, shape, or form. What we missed, I learned, was a decoupling of households in COVID, which was people went from having 1 or 2 or 3 roommates down to living by themselves because they could move somewhere more affordable and they didn't want to be hanging out with people and getting sick, and they needed better bandwidth on their Wi-Fi. Avalon Bay had a great statistic on this. The public companies have more economic data now than the federal government.
Yeah.
Avalon Bay disclosed that they went from having this huge apartment REIT, went from having 1.8 tenants, but 1.8 people per apartment to 1.6 people per apartment in a 1-year period. That's massive household formation. Yeah.
That's fascinating. Oh, so you're saying because of COVID and some fears of being in close quarters, and as you also pointed out, bandwidth, because people needed to work remotely, we saw this this breaking apart of households, and more households formed, and it was all rental. Most of it was rental, and therefore that increase in demand has was key to juicing up the rent growth that we're observing now.
I'll quote some real page data on this that was amazing. For 20 years, we never saw more than a 300,000 increase in the number of apartments being leased. This is in the institutional quality apartments. Mm-hmm. In 2021, it hit almost 700,000. Mm-hmm. And they have this data apartment by apartment. So it's super. That's not the entire country; it's a subset. But that's what happened.
Right. So
when that happens, rents go through the roof.
Right. So how does this get resolved going forward? I mean, double-digit rent growth is not sustainable, right? I mean, because people can't afford double-digit rent growth. So you're going to see some demand destruction. Households now can't form because they just literally can't afford the rent, I assume. Yeah. And are you saying that plus this increase in supply that we were talking about earlier will ultimately quell the very strong rent growth? Is that kind of your thinking?
It's not sustainable for sure, but the other piece of the data that they had, which was fascinating, and our consulting team has seen it too, is rents were up 13% year over year, but the incomes of people that were applying for those apartments, so it's not necessarily the same people as a year before, were up 13% too. Oh. And you can look at every single public company who discloses their rent to income ratios, they haven't moved. So the narrative would normally be exactly what you said, Mark. People's wages didn't go up 13%. People got to be stretching. What happened was I believe people relocated, and they took their $100,000 income with them to an area where most people make 80 grand and rented a nice apartment there. Oh. It was a fascinating pivot I never saw in a million years. But our consulting team did 900 feasibility studies last year, half of them on rental, and that's what they're seeing too. Is like these rents are up dramatically, but these people are qualifying just as easily as they did the year before and the year before that. It's crazy.
Oh, that's fascinating. So it is to some degrees also played out in the home ownership market too, right? So people left big urban centers, New York, LA, moved to cheaper areas, and that juiced up house prices. And now you're saying in those areas they moved to, in the same kind of dynamic is playing out in the rental market.
The poster child for that is Austin, Texas.
Right.
Where I mean, I think it's like 40% price appreciation or something last year. It was just insane. But one group did an analysis that actually matched people that moved and found that they sold their home in the Bay Area and bought a home that was 30% larger on a larger lot for 30% less than the home they sold. And there's a company that dominates the mortgage rate lock business who calculates the debt to income ratio on all the people that get mortgage rate locks. And despite that price appreciation, Austin, Texas had one of the lowest debt to income ratios in the country. I was stunned. Now, I think what's happening right now is that migration has stopped and you're going to be stuck selling homes to school teachers in Austin. I think it's going to be really bad in Austin, but that's what happened for those 2 years.
Oh, fascinating. Cris, what do you think of that narrative, that perspective?
Yeah, it's interesting. I'm trying to figure out, well, those people come from somewhere, right? So those markets must be negatively impact, but we don't really see that either. Yeah, there was some softening in San Francisco, but
softer.
The
rent growth in San Francisco is lower than anywhere else, but it's still high single digit.
Yeah, so trying to square the circle here. Or the other thought I have is this a one-time move, right?
Yeah.
So going forward, we won't get a repeat of this.
That's what John's saying, actually. I think.
Yeah.
And I'll square it for you. Yeah. So if San Francisco renters hadn't gone from, I'll just pick the national average, 1.8 to 1.6 per apartment, rents would have fallen. But there was some household formation in San Francisco too, because people were definitely decoupling in San Francisco.
Oh, I see.
So offsetting. Okay.
That is fascinating. That's really interesting. But you are thinking that that's a kind of a one-time shift related to the pandemic and remote work and all these movements. And as that abates, then this should come out of rent. Growth should moderate.
Right.
Yeah. This trend can't go on forever. Right?
Yeah. Oh, that's fascinating. That's very interesting. All right. Well, let me. Okay. One other question then, because there's so many riddles in the housing market, and you're answering all of them in a very interesting way. Investors. There is this. The data show that big investors, institutional investors, have really stepped it up in the single family market, the kind of the buy to rent kind of model. Some build to rent, but a lot of buy to rent, particularly in the South and in the West, the Mountain West. You've seen a lot of this activity. I guess two questions, or I've got a bunch of questions, but first two questions up front. One, did I characterize that correctly? Do you think that the way I just stated things is the way you would state it? And second, how do you think about that? Is this a good thing, a bad thing? Is that even appropriate to ask? How do you think about all the investor demand in the marketplace?
Yeah, it's probably a mix of some good and some bad.
Okay.
So, we've actually gone through the pain of geocoding every single house these guys own, and we've matched to their public disclosed numbers, so we know. So, the companies that own 1,000 or more homes nationally, so let's call those the big companies, still own less than 3% of the homes in America. But they've gone from 10 years ago, they were buying like 0%. Now they're buying, so 6% of all the homes in America recently have been purchased by them. So you're right. They've gone from 0 to 2 to 4 to 6. It's gone up dramatically. It's very concentrated in certain areas. And so I think that's what causes all the headlines, because there's some zip codes where they're 40%. And I would put those in two buckets. So they started growing like crazy in 2012 in the mortgage crisis. So they started buying homes wherever there was distress. So they have heavy concentrations of ownership in zip codes where there was a lot of subprime lending. And then what they're doing now, though, since that game is over, is they have something that all of them refer to as called a buy box, where I'm looking for a home basically around the median price in an area that has a decent rent to that home price ratio. And they're all kind of looking in the same zip codes because everybody's in the same buy box. So there's a lot of activity in those areas. And it does not add up to a huge percentage of I said 6% nationally, But in those buy box areas, which Charlotte, North Carolina is the poster child for that, and you've seen that featured in some of the newspapers.
Mm-hmm.
It is an issue if you're somebody who's trying to buy a home for your family. It's tough. The flip side of that is, and these guys get no credit for this, but I'll talk about the apartment market as a parallel here. So 40 years ago, or 50 years ago, there was no big institutional apartment market with garden apartments and professional REITs. It was all mom and pop landlords.
Mm-hmm.
Nobody's bashing those companies, because what they did over time is they created really nice communities. They charge a lot of money for it, so it's not, it's a discretionary choice to live in one of those nice communities. But they really take care of things. Things break and they fix it. The same thing is going on in single family rental housing. So yeah, you can, in fact, you should do this, Mark, on your speeches. I do this a lot lately. I ask the room to raise your hand if you've ever rented a home before, ever. And almost always like half of the people raise their hand.
Oh, is that right?
So there's this notion that, yeah, at some point, I mean, have any of you rented a home before?
I've never rented a home. A single family home? No. An apartment, but no single family. Yeah. Chris, have you? Ryan, have you guys?
Mm-mm.
I have.
No.
I've been on both sides, all sides. I've been a renter, landlord.
So there's 4. Okay, so then we'll pick on you for a minute for being one of the landlords.
And he's the crypto king now. Yeah, he owns a lot of crypto, John.
All right, so good example. 2 out of the 4 of us. I rented a home after I graduated from college with 4 roommates. It was 2 of the best years I ever had in my life. There is a stage in life where a lot of people rent a home.
Yeah. Okay. Good point.
And
good point.
Their fear is, if you have kids, your number one fear is that my landlord's going to sell the house and I'm going to have to move. But if you know your landlord is a REIT, first of all, there's a tax penalty if they sell the house, so they're not going to sell the house. So that fear is gone. I'll pick Hurricane Katrina, for example, when that hit Houston. I mean, if I was your landlord in Houston, you were done. Nobody was there to help you. American Homes for Rent, the next day, had trucks coming in from Alabama and all these other places to help clean up the house and get the tenants back in. And they didn't wait for the insurance money to fix the place, because they had the capital and they did it. There's some positives to being a tenant with these people that gets like no press. So that's what I mean. There's some positives and negatives to this, just like most policies seem to have positives and negatives.
Well, that's fascinating. So you think many people have at some point in their life rented a single family home. That's interesting.
Start asking people.
Yeah. I will.
People get relocated to Atlanta, and so you know what? Let's rent for a year to see if we like it, see if I like my new job. Check out. People get divorced, and in the meantime, we're selling our house, and I need to build back up, and we're going to split custody with the kids. I need a house.
Yeah, I guess the thing that there's a lot of good, but there's the one bad that I think it's bad. Curious, and I know we're running out of time, so maybe we'll end here. Is home ownership, right? Because obviously, if the institution owns the home, it's going to be difficult for an American family to own the home. So home ownership, which has gone up and down and all around, but really gone nowhere in 2 generations, feels like this isn't going to help out here. That's going to hurt home ownership. Do you think I have that right? And should I be worried about that at all?
Well, as I mentioned, they're not doing this in like every neighborhood in America.
Okay.
And so sure, if they outbid somebody who wants to buy a homeowner in a certain zip code, that doesn't seem to help. But home ownership hasn't plunged because of it, at least according to my math. And when we wrote this book, we went back and studied it for years, and there was this notion that the millennials were never going to become homeowners. I mean, they're all buying homes like crazy, like you were saying earlier. Right now, every generation seems to get to an 80% home ownership rate by the age of 60.
Oh, that's interesting.
And I believe that's what's going to happen. And you may have to buy a smaller home. You may have to go 5 miles further from work. You may have to relocate to a different area, which now work from home. A lot of people can, even like lower paid, telemarketing jobs can go from anywhere. I think people are going to figure it out. So I don't disagree with you, but I don't think it's the end of home ownership in America.
It's very refreshing.
One other thing I want to mention, though.
Yeah.
Well, 70% of those tenants, because we surveyed them, want to become homeowners at some point, just not right now.
Right. Good point. Right.
It's a
John,
timing thing.
John, I have to say, it's refreshing talking to you. You're the first person I've talked to in a long time where I'm having to talk you down. You feel so good. And I will say, you definitely have fodder for another book. If it's been 6 years, you got to write another book. I mean, I got the title for you.
Oh my God, that was so much work, Mark. I'm not sure I'm ever going to do that again.
Let's write it together, John. I got a good one for you. Here's the title: Riddle Me This in the Housing Market. And we just do one of these things. Each chapter is one of these riddles, and we write about it. What do you think? No,
I'll hook you up with our
you know what? Here's your problem,
Cris,
John. This is
all
the problem.
work,
Let me tell you your problem. I'm going to tell you your problem, John. The problem is you're looking out at the Pacific Ocean right now and having way too good a time. That's the problem. You got to come live in the Northeast a little bit of hardship, and then you'll start writing a book. I'm just saying. No reaction.
Come visit me in February.
John, it's so good to have you on. It was a real pleasure. And go back to the fun and sun. It was really want to thank you for the time you spent with us, and hope to have you back on again. So please take care.
Yeah, we'll do. I enjoyed it a lot, and as always, I learned quite a bit. So thanks, Mark.
Oh, you're kind to say. And with that, dear listener, we're going to call this a podcast. Till next week. Take care now. Bye-bye.